All right, let's dive right in. Today, we are talking about the bull call spread. And look, this is more than just another trading tactic. This is really about a shift in mindset. It's what separates the pros from the speculators. We're going to break down how you can use a real strategy when you're feeling good about a stock, but, not it's going to the moon good. So let's paint a picture. It's a scenario you've probably been in a dozen times. You've done your research, you've looked at the charts, and you've got this solid feeling. This stock is headed up. But, and this is a big but, you're a realist. You're not expecting it to double overnight. You're looking for a reasonable, moderate gain, maybe 3, 4, 5%. That specific feeling, what traders call being moderately bullish, actually creates a really interesting challenge. Okay, so this is where things get interesting, because what you do with that moderately bullish feeling, that's the fork in the road between an amateur bet and a professional strategy. There are two totally different ways to play this. On one hand, you've got this simple all-or-nothing play, just buying a call option. It's easy, for sure, but if you're wrong, that premium you paid is just gone. Poof. But on the other hand, you have the professional's move, the bull call spread. This thing is specifically designed for this exact situation, with risk management built right into its DNA. So how in the world does this professional play actually work? Well, the beauty of this spread is that it lets you aim for that upside you're expecting, but at the same time, it actively cuts down the cost and, because of that, the risk of the whole trade. Here's the mechanic of it. It's just two things you do at the exact same time. First, you buy a call option at a lower price, or a strike. That's your main bet that the stock's going to climb. But second, you sell a call option at a higher strike price. And the clever part is, the cash you get from selling that second call immediately helps pay for the first one. Now check this out, because this is where you can see how real that cost reduction is. In this example with Infosys, buying the call by itself costs you 50 rupees. But by turning it into a spread, you bring that upfront risk all the way down to just 35. That is a 30% reduction in your risk before the stock has even moved a single tick. Okay. Theory is one thing, but let's get our hands dirty and see how this works with real numbers. We're going to walk through a trade on the Nifty Index, and you'll see exactly how your profit, loss, and break-even are all figured out before you ever risk a dime. All right, let's build this trade. The Nifty is sitting at 78.46, so we're going to buy the 7,800 strike call. That costs us 79 rupees. That's money going out, our debits. At the exact same time, we sell the 7,900 strike call, and that brings in 25 rupees. That's money coming in, our credit. These two moves right here are the whole foundation of our spread. Now we just do some simple subtraction. We take the 79 rupees we paid out and subtract the 25 rupees we took in. That gives us our net debit. And I'm telling you, this is the most important number on the screen. In this case, it's 54 rupees, and that represents the absolute, total, maximum amount of money we can possibly lose on this trade. Period. And I just want to pause here for a second, because this is probably the most powerful concept in professional options trading. Knowing your exact, down to the penny, maximum loss before you enter a trade, that changes everything. It turns trading from a gamble into a calculated business decision. So now that we've totally defined our risk, we can define everything else. Every single spread has 3 possible outcomes when it expires: a max profit, a max loss, and the break-even point. So let's map them out for our Nifty trade. This table lays it all out. If the Nifty just kind of fizzles out and closes below 7,800, no problem. We take our predefined maximum loss of 54 rupees. If it rallies hard like we thought and closes above 7,900, we hit our max profit of 46 rupees. And that break-even point? Simple. It's our buy strike, 7,800, plus the 54 rupees we paid to get in. That's 78.54. See? Every single possibility is known right from the start. And this brings us to the big idea, the core philosophy. Why on earth would a professional want to put a cap on their profit? Well, because over the long haul, winning isn't about hitting the lottery. It's about consistently managing your risks so that your wins, even if they're smaller, steadily outpace your losses. You can really see the power of this when you look at the math over time. Think about a high-risk system. Yeah, you might win 60% of the time, but just a couple of those big losses can wipe out all your hard work. Now look at the defined risk system. The wins are smaller, sure, but the losses are disciplined. They're contained. Over 20, 50, 100 trades, that consistency is what actually builds your account. So the next logical question is, how do you pick your strike prices? It's definitely not random. The whole decision really boils down to one critical thing: time. If you think a move is going to happen fast, like within a week, you might pick strikes that are closer together. But if you're giving the trade a whole month to work out, you'll probably pick strikes that are further apart. The timeline shapes the trade. And honestly, this is what it all comes down to. The bull call spread isn't just a cool trick, it's a framework. It forces you to define your risk, define your reward, and make your decisions based on math and probabilities, not on hope or fear. That structure, that's the professional's edge. So I want to leave you with this question. When you can put on a trade knowing the absolute worst thing that can happen from the very start, how does that change your perspective? It's not about being right or wrong anymore, is it? It's about putting on smart, calculated risks. How does that one shift in thinking change the entire game for you?